I'm Roger Baker, Executive Director of the Stratfor Center for Applied Geopolitics at RANE, a global center of excellence for geopolitical intelligence and analysis. Learn how you can put geopolitics to work for your organization at ranenetwork.com.
Hello and welcome to RANE's Essential Geopolitics podcast. For today's episode, I'll be speaking with RANE's global economy analyst, Markus Jaeger, about the current state of the U.S. economy and the short-term financial outlook. Hi, Markus. How are you?
Hey, Emma. Hey, how are you? Thanks for having me.
Thanks for coming on. Can you start by giving us a brief overview of the current economic situation in the U.S., very high level, if possible?
Yeah, sure, of course. So, first of all, we are in an environment where inflation has been falling for quite some time, and economic growth has held up relatively well, much better than expected. We just got a revised second quarter numbers. GDP was up 3%. Most analysts expect like a number above 2% for the third quarter. So the economy has been holding up quite well. And what's interesting about this is the fact that this, of course, comes on the back of a very significant monetary tightening by the Fed over the past year and a half or so. And now we're in this favorable environment that economists like to refer to as a soft landing, which means you're in a scenario where inflation is coming down, but the economy does not go into recession because of higher U.S. interest rates. So I would say, as of now, we're in a favorable spot where we have continued economic activity, we have relatively low unemployment, and inflation is gradually moving towards the Fed's 2% target. Now, that doesn't mean that we're out of the woods yet. There's still certainly risks, and I think the Fed and market analysts are concerned about those. We think we're seeing some weakening on the labor market side. I mean, we're certainly seeing a weakening. The question is, like, how much weaker will things get? And the secondary question, which I'm sure we'll talk about later, is whether or not the Fed is already behind the curve. And, the Fed's been a very tight spot over the past few years. But the consensus generally is that we, for now at least, are in a situation where inflation has been coming down for a while. The Fed will probably lower interest rates as soon as September. Question mark there is, are they going to lower rates by 25 basis points or 50 basis points? I think that remains to be seen. And we are expecting, broadly speaking, continued economic activity, albeit at a slightly lower level. Having said all that, the risks have certainly increased somewhat. As you would expect, we've had high interest rates for a while, and there's always a possibility that the Fed has stayed too high for too long. And as the saying goes, economic expansions, they don't die of old age, they're typically killed by the Fed. This time around looks relatively favorable, but just so we have to wait and see what's going to happen over the next couple of quarters.
Do you have a sense of the current sentiment towards the economy in the U.S., and will this impact the decisions that the Fed makes and or how elections play out in November?
Yeah, that's a really interesting one. If you speak to any macroeconomist, they will tell you things are looking good. The economy has weathered high interest rates. We haven't seen a financial crisis, which many expected, at least some sort of accident. I mean, we did have an accident earlier last year with the Silicon Valley Bank and some liquidity pressures in the mid-tier banking sector. But overall, things look okay from a macro perspective. Inflation is like below 3% now, and it's going to converge to the target. Unemployment has increased slightly, but it's still like very, very low at a little more than 4%. That sounds pretty good. Also, what we've seen is, generally speaking, like significant wage increases, particularly among like lower income households, which had suffered quite significantly over the previous 20, 30 years in terms of real incomes. So you would think that this is a very favorable backdrop and people would be very happy. But what in fact we are seeing when we look at surveys is that there's a lot of unhappiness about the state of the economy. In fact, I think there's more than half of Americans think the economy is in recession. So that's very notable. And I think what's happened here is that people, they go to the supermarket and they see high prices and they're upset about high prices. So they're looking at levels rather than changes. But in fact, underlying economic growth, as conceived by economists, is pretty strong. unemployment is low, real wages have been rising for low-income households, at least again as far as economists measure this the right way. So you think people are fairly happy, but they're not really happy. And what's also remarkable about this, we're seeing a very significant partisan split about how Americans feel about the economy. Republicans are pretty downbeat about the economy relative to Democrats. And that's something interesting. You can trace this back to the Obama administration, where depending on whether your president is in power, you'll be like happy or less happy about the economy. So, for example, when Trump left office and Biden came in, there was a real switch. Like Democrats turned very optimistic, Republicans very pessimistic, which of course leads you to wonder to what extent these polls are actually particularly useful for economists, because if your partisan sentiment largely impacts how you perceive the economy, of how much use are they to economists? And to address the second part of your questions, I think the Democrats have had a hard time selling the Biden-Harris administration as an economic success. They're, of course, touting a success because of the investment programs, because inflation is coming down, because growth has held up quite well, and unemployment is still, relatively speaking, not at records low, but it's fairly low. But that's not how it's necessarily perceived by the electorate, taking into account the split between Republicans and Democrats. But broadly speaking, in fact, voters trust Trump more on the economy than Biden or Harris. So that's very interesting that we as economists, we will look at this and say, well, this economic environment should really favor the incumbent. But in fact, overall, most Americans, or a slight majority of Americans, do not think that the past 4 years have been very good for them, and therefore are not particularly happy about the economy, which again is counterintuitive if you look at the macro numbers.
That's really interesting. From a political perspective, how might each respective administration approach monetary policy if each were to go into office next year?
That's a really, really big question. I'll try to be brief on this, because when we're talking economic policy, we could be talking macroeconomic policy, we could be in trade policy, and to some extent they're also interconnected. What I would broadly say is that a Harris administration would, I think, by and large, continue Biden policies, not just what's been enacted, but also on the fiscal side. So for a start, Harris would let the Fed get on with its job of keeping inflation low. And then, of course, a lot would depend on whether Democrats gain control of Congress, which right now does not look very likely. It looks like they're going to lose the Senate. They may or may not win the House. That's a little unclear at this point. Probably depends on how well Harris performs in November. But it would very much depend on whether Democrats control Congress. If they do, I would expect higher taxes. We've already seen some announcements around tax relief or tax credits for home buyers and for child tax credits and so on and so forth. So I think this would sort of roughly continue Biden's policies of higher taxes and higher spending. So fiscal deficits would remain quite large in that scenario. Now, if Trump gets elected, he's already promised tax cuts. There's also the issue of making the 2017 tax cuts permanent. That's something that he would do. Again, here it very much depends on whether Republicans would gain control of Congress. My guess is if Trump wins, there's a much higher chance that the Republicans will control Congress than if Harris wins. Now, in that scenario, I think his fiscal plans are to be taken more seriously in the sense that they might get implemented. If we have a split Congress, a divided government, of course, then it's a different scenario. Then it comes really down to negotiations, and we might not get all that much done, though I think some compromise is possible. I think what's remarkable, though, or worth remarking on when it comes to Trump macro policies is that he's been attacking the Fed pretty consistently. I mean, even when he was in office. But there's even now some proposals floating around the Trump universe that seem to suggest that the Fed should be made less independent and should run its interest rate decisions by the president. Now that, of course, I don't think this is going to go anywhere, but I think it's worth noting, because then what you ideally would get from a Trump perspective is you get tax cuts, you get low interest rates, and then you would also get, and I haven't talked about this yet, presumably the threat of a trade war or an actual trade war. And if that happens, you're in a scenario where it's not difficult to see how inflation could go up quite a bit under Trump administration. But again, that assumes that Trump would do what he says he was going to do, which is impose 10% tariffs on all U.S. imports. We'll have to wait and see whether he actually makes good on that promise. It also assumes that he would gain control of the Fed or somehow can coerce the Fed into not raising interest rates. And it would also assume that he has control over Congress. But so overall, I would say we get continuity when it comes to Harris, and I think under Trump there will be a fair amount of uncertainty, not just because we don't exactly know whether he's serious about what he's been talking about, and he's been talking about many other things like replacing the income tax with like tariff revenue, which seems difficult to sort of imagine economically. But even like the stuff that is sort of more tangible, like his again the tariff policy, his weakening of, or his desire to weaken the Fed and lower taxes would certainly be more inflationary. But, and I'll finish on this, what would certainly characterize both administrations is high deficits. They're not going to go away under either scenario, and under either scenario, and also under any scenario, it doesn't really matter which way Congress swings. Deficits are going to stay relatively high in the US, and this will continue to increase debt, even if the economy continues to grow at an okay pace over the next few years. So a few years down the line, not next year, not the year after, but 5-10 years from now at the very least, there will be some serious questions to be asked about how to adjust fiscal policy and how to rein in federal government debt.
Well, thanks for that overview, Markus. It was great speaking with you, as always, and I hope to hear more from you soon.
Thank you very much, Emma.
For more risk insights and analyses, visit ranenetwork.com, where you can learn more about our suite of risk intelligence products and solutions. That's RANE network.com. Thanks for listening.